Welcome to the Deep Dive. Today we're tackling a real cornerstone of smart investing, John C. Bogle's The Little Book of Common Sense Investing.
That's right.
You reached out because, well, you wanted a clear, efficient way to understand sound investment principles,
Yeah.
right? Without getting totally bogged down in complexity.
Exactly.
So our mission here is to really distill the essential wisdom from Bogle's work. We want to see how it can immediately sharpen your perspective on investing for the long haul.
Precisely. We'll be digging into the core ideas Bogle laid out, looking at index investing, why keeping costs super low is so critical, the whole idea of market efficiency, the need for patience, that long-term view.
Right. And asset allocation diversification.
Yep, those two. And maybe touch on some common mistakes to avoid and, well, why Bogle's fairly straightforward thinking is still so relevant today.
Okay, let's unpack this. Starting with index investing. For anyone listening who might be newer to this concept, what exactly is index investing? Simply put, it's about choosing funds designed to basically copy the performance of a market index. Think like the S&P 500.
Okay.
So instead of trying to, pick the next winning stock or actively manage things to beat the market.
You're just buying a slice of the whole thing.
Pretty much, yeah. A representative slice of the overall market, or at least a big chunk of it.
And Bogle really hammers home that this simplicity is actually a major plus, doesn't he?
He does. His argument is that this direct approach, it generally leads to better long-term results for most people. Why? Because it's just more efficient.
Less messing around, basically.
Kind of. Think about active management.
Yeah.
It needs constant research, complex analysis, lots of trading. All that adds complexity and, frankly, more chances to slip up. Indexing cuts a lot of that out.
And here's where it gets really compelling, I think. The data seems to overwhelmingly show that most investors, even the professionals, they really struggle to actually beat the market over time.
That's a key point.
Why is that? What
Yeah.
makes it so hard? Well, there are a few big reasons. First, those high costs tied to active management fees, trading costs, admin stuff, they really chip away at your returns.
All right.
Then there's the frequent trading itself. That can mean higher taxes, more transaction costs.
Okay.
And maybe the biggest thing, consistently predicting where the market's going next is just incredibly hard. Almost impossible for most people most of the time.
So the costs and the sheer difficulty of prediction create this huge hurdle.
Exactly. A significant hurdle for active managers to consistently overcome.
You know that saying, if you can't beat 'em, join 'em? The track record comparison between index funds and active funds seems to really bear that out.
It absolutely does.
Yeah.
Take the Vanguard 500 index fund, the one Bogle himself started back in, 76?
Yeah.
Over the long run, funds like that have tended to deliver pretty consistent, stable returns, largely because they have low costs and they give you that broad market exposure.
And when you compare them to most actively managed funds...
Over long stretches, index funds often come out ahead. It's documented pretty well.
So Bogle's core idea really just boils down to, can't beat the market, then just join it. That's quite a shift if you think investing is all about finding that one magic stock.
It is. It's a fundamental shift in perspective that Bogle really championed. It's about saying, look, the market's pretty efficient. Let's focus on capturing its returns in the cheapest way possible.
Okay, let's pivot slightly to another huge piece of Bogle's philosophy. This power of low-cost investing. It sounds obvious, maybe, but the impact, it would be massive, right?
Oh, it's deceptively simple, but incredibly powerful. Think about it. Every single dollar you pay in fees or expenses,
Yeah.
that's a dollar that isn't working for you. It's not compounding, not growing your wealth. Over the long term, these little percentages, they make a huge difference to where you end up.
Bogle uses an example that really drives this home, showing how even a small fee difference can cost you like tens of thousands over the years. You mentioned even a 1% fee takes a big bite.
A huge bite. Imagine you invest, say, $10,000. You get a decent average return, maybe 7% a year. If you're paying a 1% management fee every year, the total amount those fees eat up over like 30 years is substantial. It really drags down your final result compared to someone in a fund with super low costs.
And that's a big reason why these low-cost index funds often end up outperforming the pricier, actively managed ones.
Precisely. Passive management, just by its nature, has way fewer costs baked in. You don't need massive research teams. You're not trading all the time, lower admin overhead.
Right.
Those savings get passed straight to you, the investor, as lower expense ratios.
It's interesting that compounding effect we always talk about for games.
No.
It works in reverse for fees too, doesn't it? People might not always clock that.
That's such a crucial point. Just like your returns snowball, the negative drag of fees also compounds. So the more you save on fees,
The more money stays in your pot to grow.
exactly, more capital working for you, generating more growth.
Bogle has this really eye-opening illustration in the book. Can you maybe walk us through that example?
Sure, he paints a picture. Two investors, right. Both start with $10,000.
Yeah.
Both somehow manage to earn exactly 7% a year before fees.
Okay, identical scenario so far.
But here's the difference. Investor A pays 2% in fees each year. High, but not unheard of. Investor B pays just 0.1%. Very low, like a good index fund,
Right.
after 30 years. Investor B, the low-cost one, ends up with over $76,000.
Wow. And Investor A.
Investor A, paying those higher fees, only has about $43,000.
Wait, that's a difference of over $30,000 just from fees.
Just from the fees. It's a stark illustration. Really shows the long-term cost of what might seem like small percentages.
That is genuinely staggering. And like we touched on, the broader data keeps showing most active funds don't beat their benchmarks long term, often because those higher fees just cancel out any skill the manager might have had.
That's right. It's incredibly tough to consistently find those star managers who can actually deliver better returns after you account for their fees. The odds just aren't in your favor as an investor trying to pick them.
Okay, moving on. Bogle also really emphasizes understanding market efficiency. Now, for someone who isn't, an economics professor, what does this efficient market hypothesis, the EMH, really mean for us practically?
In simple terms, EMH basically suggests that right now, stock prices already reflect all the information that's publicly out there.
So no secret bargains waiting to be found.
It implies it's really, really hard to consistently find stocks that are significantly underpriced or overpriced. The market, meaning all the buyers and sellers, has kind of already factored in the collective knowledge.
Okay, so what does that mean for things people often try to do, like timing the market or picking individual stocks?
Well, if the market is mostly efficient, then trying to jump in and out at the perfect times, buy low, sell high, becomes a really unreliable game.
It sounds appealing, though.
Oh, definitely. But the evidence shows even the pros struggle to do it consistently. You've got trading costs, taxes, and just the high chance of guessing wrong. It usually ends up hurting more than helping.
And for stock picking.
Similar idea. If the market quickly absorbs news about companies into their stock prices, then consistently beating the market by picking individual winners is also a massive challenge.
It's not impossible, perhaps, but very difficult to do consistently over time.
It's like the market is this giant, super fast information processor.
That's a good way to think about it. Constantly taking in news and adjusting prices.
Okay, let's shift to playing the long game, the long-term perspective, the virtue of patience. This feels especially important today with so much focus on instant results.
Oh, absolutely. In investing, time is probably your greatest ally. Taking that long view lets you harness the real power of compound growth.
That snowball effect, right?
Exactly. Your returns start earning their own returns. It's how serious wealth gets built, but it needs time. Lots of it.
And having that long-term focus also helps cushion the blows when the market inevitably gets choppy, doesn't it?
A crucial shield, yeah. Markets go up, markets go down. That's just what they do. Short-term volatility happens.
If you react emotionally to every dip, you can end up making really bad decisions, like panic selling right at the bottom. A long-term focus helps you stay the course.
So tune out the daily noise. Keep your eye on the long-term prize.
Precisely that. It's about discipline, focusing on long-term value, not short-term jitters. And look at the history. Despite all the crashes and corrections, major stock indices, like the S&P 500, have shown a clear upward trend over the long haul. It rewards the patient investor who stayed put.
And I bet taking that longer view helps with stress levels, too. Less constant checking and worrying.
It certainly can. If your focus is on your goals 10, 20, 30 years down the line, not on today's closing price, it can definitely lead to a much less anxious investment experience.
Okay, now a really fundamental piece of any solid strategy, asset allocation and diversification. Can you break down why these are so vital, both for reducing risk and maybe even boosting returns?
Okay, think of asset allocation first. It's like creating the right financial recipe for you. It's deciding the best mix of broad categories, typically stocks, bonds, and maybe cash.
And how do you decide that mix?
It really depends on your specific situation, your financial goals, how comfortable you are with risk, your risk tolerance, and how long you plan to invest, your time horizon.
So it's personal.
Very personal. The aim is to balance the potential for higher returns, which usually comes with stocks, and more risk.
Right.
with the need for stability or capital preservation, which bonds often provide. So a younger person saving for retirement decades away might have way more in stocks than someone already retired who needs income and stability.
Okay, that makes sense. So that's asset allocation, the big picture mix. Where does diversification fit in?
Diversification happens within those categories. It's the classic, don't put all your eggs in one basket idea.
Got it.
So within your stock allocation, you don't just buy one or two companies. You spread your money across many different companies, maybe different industries, even different countries.
Why? To reduce the hit if one does badly.
Exactly. If one company tanks, it doesn't sink your whole portfolio. Same idea with bonds. You'd hold various types, different maturities, different issuers.
So allocation sets the main ingredients. Diversification spreads them out within each bowl.
That's a great way to put it, yeah. And they work together, asset allocation and diversification. They create a more resilient portfolio
How so?
because different assets and different investments within assets, they don't all move up and down at the exact same time. Diversification helps smooth out the ride, potentially reduces big swings, gives you more consistent returns over time.
And Bogle was a huge fan of using things like low-cost index funds and ETFs to achieve diversification easily, wasn't he?
Oh, absolutely. He saw them as perfect tools for it. An S&P 500 index fund, boom, you instantly own pieces of 500 large U.S. companies across many sectors.
Instant diversification.
Pretty much. Same with the total bond market index fund. They do the heavy lifting of diversification for you, and they do it cheaply.
Okay, lastly, let's touch on those common pitfalls. The behavioral traps that Bogle warns about, the ones that can really cost investors.
Right. This is where our own psychology can work against us. A big one is overconfidence.
Thinking we know better than the market.
Yeah, believing we have some special knack for predicting things or picking the absolute best stocks. This often leads to trading too much, trying to be clever, and usually ending up with worse results. Another trap is reacting to all the market noise, the scary headlines, the financial TV chatter.
Getting spooked easily.
Exactly. Making impulsive moves based on short-term news that really undermines your long-term plan.
And what about chasing performance, that fear of missing out or FOMO? Jumping into whatever's hot right now.
Oh, that's a classic mistake. Piling into funds or stocks after they've already had a great run.
Because past performance doesn't guarantee future results.
Precisely. It often leads to buying high, right before things cool off. So you buy at the peak and then maybe sell when it drops. The opposite of what you want.
So how do you avoid these traps?
This comes back to discipline. Having a clear long-term investment plan based on your goals and risk tolerance, and then sticking to it. Through thick and thin. Ignoring the noise, resisting the emotional urges. Patience and discipline are the antidotes.
It really is remarkable how these fairly straightforward common sense ideas from Bogle still hold so much weight, even with how fast the financial world changes. What's your take on the future of investing, considering his legacy?
You know, despite all the tech advances, new products, robo-advisors, AI, Bogle's core principles seem more relevant than ever.
Really? Even with AI and big data?
Well, think about it. Many robo-advisors actually build on his philosophy, offering diversified, low-cost portfolios automatically. And while AI and data analytics are powerful tools,
Yeah.
they haven't really solved the fundamental challenge of consistently timing the market or picking stocks to outperform long-term, especially after costs. Technology can help, sure, but doesn't replace that disciplined, long-term, low-cost, diversified strategy.
So the tools change, but the underlying principles of good investing, they kind of stay the same.
That's how I see it, especially when you really internalize the power of compounding over decades, the massive impact of minimizing fees, and just the historical difficulty of active management consistently winning. Bogle's common sense is still a powerful guide.
Especially maybe when markets get volatile.
Absolutely. During uncertain times, having that steady, diversified, low-cost approach provides a lot of stability. His legacy is really like a clear beacon for investors, young and old, trying to navigate what often feels like a super complex financial world.
Well, this has been a really fantastic deep dive into John Bogle's The Little Book of Common Sense Investing. Let's maybe quickly recap those main takeaways.
Sounds good.
Okay, so first, index investing. It's a simple, efficient way to just capture market returns. Second, costs matter a lot. Keeping them low is absolutely crucial for maximizing your growth over the long run.
Definitely.
Third, trying to constantly outsmart the market, whether timing it or picking stocks. Probably not a winning strategy for most people over time, thanks to market efficiency. Fourth, patience and a long-term view are vital. They let compounding work its magic and help you ride out the inevitable bumps.
Stay the course.
Fifth, smart asset allocation, that mix of stocks, bonds, etc., and broad diversification within those assets. Fundamental for managing risk and smoothing returns.
Essential building blocks.
And finally, watch out for those behavioral traps. Overconfidence, reacting to noise, chasing trends. Avoid them by sticking to your plan.
Yep, know thyself, investor. Bogle's ideas, they seem simple, but together they form a really robust, time-tested way to build wealth.
Okay, so considering everything we've talked about, here's a final thought for you to chew on. How might truly embracing this long-term, low-cost, broadly diversified approach actually reshape how you think about your own financial journey and future? What assumptions maybe you held about needing to be an active trader or needing to find that star manager might you now question a bit more critically? Thanks for joining us for this deep dive.